Jim Rickards sounds the alarm. This crash will be catastrophic. Jim Rickards serves as the editor of the financial newsletter Strategic Intelligence, advises the Office of the Secretary of Defense in the U.S. intelligence community on capital markets, and is on the Center of Economic and Financial Power Advisory Panel in Washington, D.C. Jim believes that since 2007, the world has been in a depression, and it will continue indefinitely. Like many others, Jim Rickards has been warning that the situation is even worse than we are led to believe, and that a depression is upon us. In this video, we will expound on how he sees the global economy and will examine why he's so bearish on stocks, and explain the generational crash looming on the horizon. Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video. And turn on the notification bell to keep posted. Now, without further ado, let's head on to the video. A recession is technically defined as having growing unemployment and 2 consecutive quarters of decreasing GDP. The National Bureau of Economic Research serves as the unofficial but well-regarded referee on whether or not we are in a recession. However, Rickards claim that we are in an expansion. So, based on this, one could wonder how we can be in a slump if we are in a 10th year of an expansion. According to Rickards, most individuals are unaware of what a depression is. They make the intuitive assumption that since a depression sounds worse than a recession, and a recession is 2 quarters of declining GDP, a depression must be 6 quarters of declining GDP. However, this does not constitute a depression. Depression is a prolonged period of growth that is below trend, with no specific tendency to collapse or return to trend. Rickards cited the US as an illustration to make his point. For example, if trend growth is between 3 and 5%, roughly the United States' long-term potential, and you're now operating at 2%, the gap between 3.5% and 2% is depressed growth. People can initially think that just 1 percentage point difference is relatively minor and unimportant. However, according to Rickards, such a gap is enormous and the difference between the trend line and the actual line increases as time goes on. According to Rickards, the amount of wealth lost due to this depressed growth amounts to $5 trillion. On the other hand, debt levels are rising at a higher rate than growth. Is debt beneficial or harmful? It depends. If you can afford it and put your debt to good use, debt may be beneficial. It's harmful if you can't afford it since it won't be sustainable in the sense that you are substituting debt for genuine growth, and everything will crash and burn. Debt cannot be understood in isolation. You must understand debt in relation to income and the GDP ratio. The GDP is sort of chugging along, said Rickards, but the debt to GDP ratio is becoming worse. A worldwide debt crisis appears to be on the horizon. We're not quite there yet, but we may get there soon. Additionally, according to Rickards, there is a lot of reason to doubt that the Fed will tighten. Rickards added that until one of the 3 pause factors, a disorderly collapse in stock markets, unemployment, or disinflation or deflation applies, the Fed will tighten monetary policy 4 times a year in March, June, September, and December. Currently, the stock markets are fluctuating, but they are not crashing. The Fed does not worry if the stock market falls 15% over the course of 6 months, but they do care if it falls 15% over the course of 6 days. However, this is not the case at the moment, and none of the aforementioned 3 factors apply. Moreover, the job market is thriving. We are no longer in the danger zone of disinflation, and inflation is increasing. So one should anticipate that the Fed would just keep raising interest rates. According to Rickards, there is no question that the Fed is over-tightening since they were also attempting to normalize the balance sheet in addition to attempting to bring interest rates back to normal. However, the Fed is currently faced with a problem. What will they do if the US economy enters a recession? We are in the 10th year of an expansion, and as Rickards said, historically speaking, it takes around 4 points of cuts or 400 basis points to pull the economy out of a downturn. In other words, the Fed has to decrease interest rates by 4% in order to help the economy recover from a recession. However, how can you reduce interest rates by 4%? The answer is no, you cannot. You reduce them to zero and then you are trapped at the zero limit. The Fed, on the other hand, is attempting to hike rates and lower the balance sheet in order to be able to cut rates and, if required, engage in quantitative easing when a recession occurs. However, is it possible to normalize the balance sheet and interest rates without bringing about the recession you're attempting to fight? According to Rickards, the answer is no, and they will likely bring about the next recession by trying to tighten up in preparation for it. However, the Fed has never predicted a recession and has a poor track record of predicting. We are all aware that stocks will decline. As a result, Rickards declared that he is bearish on stocks and not bullish on growth. According to Rickards, as soon as signals of a recession start to appear, the Fed will alter its course. The yield curve will reverse, growth will decline, and the rate of employment creation will also slow down. What will transpire is just enough warning signs rather than a full-blown recession or catastrophe. As per Rickards, the next crisis is worse, and the future might be drastically different. Prices may fluctuate, but as a trader, you may profit anywhere in between. The actual behavior of markets is diametrically opposed to any model employed by economists or the Fed. Therefore, it should come as no surprise that forecasting is inaccurate. On the other hand, a collapse or financial panic is entirely different. A financial panic is not equivalent to a recession or a change in the business cycle. As said by Rickards, complexity theory demonstrates that an exponential function of scale is the worst thing that can occur in a system. Scale simply refers to how large it is. It includes debt, scaling metrics, the average daily volume on the stock market, and the gross notional value of derivatives. Some exponential function is involved if you triple the system to, say, by a factor of 10 or 50. Meanwhile, the ratios of debt to GDP are substantially worse, and the gross notional value derivatives are significantly larger. Therefore, according to Rickards, there is a greater concentration in light of these metrics, debt, derivatives, and the fact that the 5 largest American banks now account for a larger share of total banking assets than they did in 2008. Rickards further added that this is an additional risk factor, and based on complexity theory, the next crisis will be exponentially worse than the last one when all of these factors are considered. According to Rickards, crises always occur, and this one will be significantly worse because of the scaling metrics. Who's prepared for that? In other words, the issue has remained the same and the number of bailouts has simply increased. What is greater than the central banks? Who is capable of bailing out the central banks? There is only one organization and one balance sheet in the globe that can do that, and that is the IMF. The SDR, or special drawing rights, is essentially the IMF's own money that they print. They have a printing machine, and it will be the sole source of liquidity in the next crisis, because the central banks will have little room to operate if they don't normalize before the crisis, and they won't be able to expand their balance sheets past a certain point, since doing so will undermine confidence. Where is the source of liquidity? The answer is that the IMF provides it, a worldwide monetary reset or financial Armageddon. Hi, we hope you liked watching this video and learned something important. If you enjoyed it, please like, subscribe, and hit the notification bell to stay up to date on our videos, and make sure to leave your thoughts in the comment section below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Until next time.